Hi, I'm Ian Stewart, Chairman of the Board of Leithner Company, and it's my very great pleasure to welcome you to this presentation of the operations for Leithner Company, timed for the end of the first quarter of the financial year 25-26. We hope the presentation demonstrates to you our commitment to transparency, but also our continuing commitment to the philosophies that have guided Leithner Company for the past 25 years. I look forward to any comments that you wish to make about our presentation, and without further ado, I'm more than happy to hand over to my fellow director, Mr. Chris Satrafillis, who will guide us through today's presentation. Over to you, Chris.
Thanks, Ian. Before we begin, there's the disclaimer. Please pause the video and read that at your own speed. As we go through the normal quarterly process, David will begin by discussing the long-term, medium-term and short-term results of our company. He'll then proceed to look at the asset allocation and the top 5 holdings as at 30 June of this year. We'll then pass across to Chris, who will discuss some of the recent portfolio activity and discuss in detail one of the new additions to our buy list. And finally, I'll close off proceedings with some additional information about our metrics and also how you can contact us if you've got an interest in investing. David, over to you.
Thanks, Chris. So what we have here is a graph going back to our commencement in June 1999. Seems a long time ago, and it was a long time ago. Roughly speaking, we've matched the index since commencement. The index has done 8.4% as a compound average growth rate. We've done 8.2%. As you can tell, when the numbers are that close together, there's a fair bit of variability month to month. Sometimes we're outperforming the index, sometimes the index is outperforming us. If you look at the way they've been achieved, though, we're a lot more consistent. So we don't have any of the massive uprises that we've had, in our market more recently, but we also don't have the downdrafts that the overall market tends to get. If you have a look at that and you look at, where the index is placed, I like to think we're pretty well placed going forward from where we are. So if we go to slide 5. What we're looking at here is our medium-term performance. So this is basically from the start of COVID. COVID really broke out in about February, March 2020. So this goes from January 2020. Have a look at the start there. Obviously, the index has a massive fall, falls from, roughly 27%. We fell about 6 or 7% at one point in time, and that was only for a short period of time. So in those tough environments, we do a lot better. As you can see through the period, it waxes and wanes. Sometimes we're ahead of the index, sometimes we're slightly behind. But again, where we're placed at the moment compared to where the index is placed, I believe we're pretty well positioned for outperformance going forward. The losses that we've had, no major losses. If you look at the index periodically, it does wane. There's some serious falls there. Going through the next slide, number 6. So this is very short term. So this is January to July of this year, us compared to the index. Index is in blue and we're in red. Generally, we'll never get the highs that the index gets. We're not long Commonwealth Bank. We're not long WiseTech, some of these other companies that go up dramatically. But similarly, February the market falls 4%. We were up slightly. March the market falls 3.5%. We were down a minuscule amount. So we've got a lot less downside than the index, and we just methodically produce returns pretty regularly, as you can see from there. The standard deviation is a financial metric for volatility, basically how much your returns wiggle around. Ours is about 1.6%, which is very low, and the index is about 4.2%, which is considerably higher. We're about 40% less volatile, as volatile as the index. We believe that will continue. It has continued for 25 years now, so I think that's how it'll go for the future. Overall, our asset allocation on the next slide. Since commencement, we've averaged 52% of our assets in cash. Ideally, we'd like to be more invested than that. Our rough goal would be to, our maximum would be, say, 80% invested. We'd always want an amount of cash in our company just to make sure that we've got a Fort Knox balance sheet. So we would like to be slightly more invested. We will be when we find things to invest in, but at the moment we're finding not as many things as we might like, but probably similar to what we found over our duration. So at the moment we're about 49% in cash as at 30 June, which we believe will be probably where it'll stay for the short term. There's not so many things that we're finding that'll change too dramatically. What it does do, though, is provide a massive base under our assets. So if the market swoons dramatically, we're not going to feel it anywhere near as much as the index. It also gives us the ability to buy things when they pop up, and Chris will go through a few things that we've been doing through the assets that we hold. It also allows us to write options. Again, Chris will go through that in a little bit more detail. So our cash, rather than being a negative, I think is a pretty big positive. We're well positioned for anything that might pop up. Just going to the next one. In terms of where we're at the moment, we've got the 5 largest positions outlined there. Most of these companies people will know. They're big companies. They've been around for a long time in most cases, some cases hundreds of years. Very solid, very stable. That's what we look for. We try to buy those sorts of companies when they're cheap. We've got Origin there, held it for a long period of time. There was a takeover offer a couple of years ago at a very much lower price than it's at the moment. We thought that was probably slightly underpricing it. History's shown that was probably the case. We still think it's reasonable value, not exceptional. We're not buying more, but we still think it's more than capable of being held. APA, largest gas pipeline in the country. IFL, massive financial services company, has been going through some problems, but has a takeover offer on the table now. Santos, again, gas company, takeover offer on the table. And the last one's Telstra. Look, everyone hates Telstra, but they still have a very good mobile network. And, that one's probably, of those 5, the closest to being a sell. We've done quite well out of it, and it's probably closer to our sell price than our buy price. But at the moment, it still remains a reasonable part of our portfolio. And I believe I can now pass over to you, Chris. T.
That'll be me. Thank you, David. Let's change, Chris, to the slide that's headed Actual and Anticipated Changes to the Portfolio. And the key points there, we're long-term investors, and since January of this year, we've not sold any shares. We have, however, sold plenty of put options. That is, we've contracted to buy more shares over 2 companies, Santos and Woodside, whose shares we already own. Those options have expired. We also have written puts over Flight Centre, which at this stage, they'll also likely mostly expire or completely expire. And finally, we've updated research on BHP and Woolworths, and we'll write puts over them if and when their market prices fall to our buy prices. So let's turn to Flight Centre and the slide headed Why Do We Like Flight Centre? As a rough rule, we seek to buy companies who are leaders of their fields, who've recently encountered what we regard as temporary difficulties. Flight Centre amply qualifies. It's not widely known, measured by its total transaction value, which goes by the acronym TTV. Flight Centre is one of the world's top 10 retailers of travel-related products and services. Its portfolio of businesses also runs the gamut. It includes adventure, corporate, cruise, exotic and luxury, family, and student and youth travel businesses. These businesses operate globally, that is, throughout Australia and New Zealand. In North America, it operates in Canada, Mexico, and the US. In Europe, the Middle East and Africa, it operates in Britain and Ireland, across the European Union and in Switzerland, the United Arab Emirates and South Africa. And finally, in Asia, it operates in China, including Hong Kong, India, Japan, Malaysia, and Singapore. In these countries, Flight Centre operates under multiple names. It also licenses its brands in an additional approximately 90 countries. It's truly a global business. So let's go to the next slide, which is titled, Why Do We Like Flight Centre, Roman numeral 2. It plots Flight Centre's long-term returns. Our company research is quite thorough. In this case, we've analyzed Flight Centre's financial statements since it listed on the ASX in 1995. We've uncovered much more than I can describe in a short video, but it's worth emphasizing. The analysis of financial statements is the core of our analysis of companies, but it's certainly not all that we analyze. We also calculate and assess a company's long-term returns, and the chart summarizes Flight Centre's. The key thing that the chart tells us is that for most of the time since 1995, Flight Centre has massively outperformed the All Ordinaries Index. But during COVID-19 and also during the global financial crisis, it massively underperformed. In both cases, it quickly gave back all of its previous outperformance. As a result, over the 30 years to June of this year, Flight Centre hasn't outperformed the index. Given what our analysis of its financial statements has uncovered, though, as well as what I'll outline now, we don't expect that to continue. In other words, it's reasonable to expect that Flight Centre's outperformance will resume. Okay, so let's go to the next slide. That's entitled, Why Do We Like Flight Centre, Roman numeral 3. It uses data from Australia's national accounts since 2005 to quantify the size of this country's tourism industry and its major components. The first one is domestic/household, the second one is corporate, and the third one is international. In Australia, the tourism industry generated about 3% of the country's GDP, and before COVID-19, this percentage was growing. As GDP continues to grow and as incomes rise, it's reasonable to expect that tourism will continue to expand. Its largest component, tourism by domestic households, is now larger than it was before COVID. We expect that international tourism and corporate travel will, before long, also be bigger than they were in 2019. Okay, next slide. Excuse me. Why do we like Flight Centre, Roman numeral 4? This slide extends and elaborates this key point. It uses data from America's national accounts to quantify the size of that country's tourism industry and its major components since 1929. So that's the better part of a century's worth of data. The crucial point is that for almost a century, as a percentage of GDP, tourism in the States has been a growth industry. If America's GDP continues to grow and incomes rise, tourism in that country is going to continue to expand. A similar point applies to Canada, New Zealand, China, Hong Kong, Japan, and Western Europe. And these are all countries where Flight Centre operates. Okay, last slide, which is the one entitled, Why Do We Like Flight Centre, Roman numeral 5? This last slide uses American data since the 1960s to explain why, at least to some extent, tourism has long been growing. It's not just because people and countries are richer, it's also because the price of tourism-related products has been falling. Over the decades, incomes have risen, but flights, for example, have become much cheaper as a percentage of average weekly incomes. By this standard, over the past 60 years in the US, the cost of flights has fallen by something like 80%. Higher incomes and cheaper flights means higher demand for travel and tourism. The crucial point is that as incomes continue to grow and flights and presumably cruises, tours and the like become cheaper relative to income, demand for flights, travel, cruises, tours and tourism as a whole will continue to grow. That bodes well for Flight Centre's long-term fortunes. So that's all from me. Back to you, Chris, and the next slide.
Thanks very much, Chris. So just to summarize our current metrics, the current ex-dividend net tangible assets are at 98.8 cents per redeemable preference share. Applications and redemptions are processed at that monthly net tangible asset backing figure. Our current market capitalization is at 35 million, and we intend, as we've mentioned in the past, to soft close at 100 million. And just to summarize the presentation, returns are consistent with the long-term performance of the investment company. We are very well cashed up and have the opportunity to put some of that cash to work with some of the companies like Chris has demonstrated with Flight Centre. If you're interested in becoming a shareholder, please reach out to speak to either Chris or David via our emails and contact details on the following slide. The minimum application is $500,000 with some limited scope for smaller investments. You can only apply on the application form attached to the current information memorandum. And here are the contact details. And we look forward to speaking to you with any queries you have. That's it from me, and thanks everyone.
Thanks everyone.